Welcome to Better System Trader, the podcast to help systematic traders of all levels improve their trading. We'll give you loads of expert tips and practical advice on system design and validation, money management, trading psychology, and many other topics. Whether you're just starting out or a savvy systematic trader, we're here to help you improve your trading and find more success. This is Better System Trader with your host, Andrew Swanscott.
Hi and welcome to Better System Trader. Thanks for joining us for this very special episode. It's been an extremely busy week with the episode 100 celebrations and the giveaway. And then to top it off, I went down to the Mornington Peninsula this weekend to drive supercars. So on Saturday, I had the opportunity to take a Ferrari 360 out for an hour. And then on Sunday, I did the same with a Lamborghini. And both were awesome cars. But that Lambo, that was incredible. That thing is quick. Now, that's not the only excitement for this weekend, though, because we also have the matter of the giveaway to celebrate episode 100. And I'm excited to announce that we do have a winner. And that lucky winner is Peter Konomos from Sydney. I've been in touch with Peter already, and he's super stoked to win the prize and get stuck into it. So congratulations to Peter, and also a big thanks to everyone else for participating. Now, I didn't mention this before, but we also have a small prize for everybody else who entered the giveaway. So even if you didn't win the major prize, you still do win something, just to say thanks. So details about your prize will be emailed to you over the next few days. So keep an eye out for an email from Better Trader Academy where you can find out what your prize is and how to access it. And one final announcement before we move on as well. Now, two of the courses that we included in the giveaway, that is the System Trading Unleashed course and the Breakout Strategies Masterclass. Both of these are currently available by private invitation only. They're not open to the public, but we do have a waiting list for both of those. Anyway, we had a huge response to those, and a lot of people signed up to those waiting lists, so much more than we expected. So we're kind of currently looking at what we can do to help everyone who joined those waiting lists. Now, we're not exactly sure what we're going to do there yet, but we have a few ideas. So if you did join that waiting list, keep an eye out for an email, perhaps over the next few weeks. And if we figure something out, we'll let you all know. And finally, if you did miss out on details about the courses or you want more info, head on over to the courses page on the bettersystemtrader.com website. I've put some details on the page there for you because the giveaway page is going to be taken down very soon. Anyway, enough of the announcements. It's time to move on and talk about trading. And in this episode, we're going to focus on price patterns. So let's just jump straight into it. I've done enough talking already. Our guest for this episode is Brent Penfold. So let's jump over to my chat with Brent on price patterns. Hi, Brent. Welcome, and thanks again for joining us.
Oh, it's my pleasure, Andrew, and thank you for having me on.
Now, I think this is your second guest appearance on the show, and the first one was way back on episode 2, which is nearly 100 episodes ago. So it feels like such a long time ago. But you were my second ever guest, so thanks for that, and it's really an honour to have you back again.
Oh, it's a pleasure, and I have to give you congratulations for having so many people on your show and to essentially get a century of podcasts. Well, that's amazing. So well done to you.
Thank you. Yeah, we've been very lucky to have some awesome guests on the show. So that's great. Now, for people who may not have heard that the original episode we did way back in years ago, maybe do you want to just give us a little bit of a background on yourself and how you got started in trading?
Oh, sure. Well, luckily, this is a podcast and it's not TV because I probably look every year that I'm 55 years old. I don't feel 55, but I am, and unfortunately, that means I've been involved with the markets for a very, very long time. Mm-hmm. And essentially, I've been involved with the markets for over 30 years since I joined Bank of America as a trainee dealer in 1983. My background in a 30-second brief version. Mm-hmm. Essentially, I started as a trainee dealer at Bank of America. I ended up being responsible for looking after the bank bill futures. And that essentially gave me a huge introduction to futures where, by legacy or by default, I'm still in that space. However, I think I'm very lucky to be in that space because, in my opinion, I think futures is one of the superior trading instruments for active traders. As a trader, I specialize in trading global index, currency, and commodity futures. I've written a couple of books. My second book, which most people know me for, has now been translated into Polish, German, Japanese, Korean, simplified Chinese, and Orthodox Chinese.
Wow.
Yep. I help educate people. I'm lucky enough to be invited to present throughout the Asian region. I've spoken to traders in Vietnam, India, Singapore, Malaysia, New Zealand, in China. And I'm a licensed advisor, and I publish newsletters for active traders. So that's me in a nutshell.
Awesome. Now, I know that you do trade a lot of markets around the world. So can you just give us an idea of where you're trading, or what markets you trade?
Oh, sure. I essentially actively trade almost 30 markets. So my background is that I was essentially an index trader, and that expanded from our local index in Australia, the share price index futures contract. That led to a global portfolio of index contracts. So I trade our Australian SPY, the Nikkei, the Taiwanese, the Hang Seng, and I shift across to Europe. I trade the FTSE, the Stock 50, and the DAX, and going across to North America, I also trade the E-mini NASDAQ and the E-mini S&P. In terms of currencies, I just trade the 5 main currency pairs against the US dollars, which is the Euro currency, British pounds, yen, Swiss, and Aussie. And I trade a portfolio of commodity markets, which is spread across interest rates, softs, grains, meats, metals, energy.
So basically everywhere obvious anyway.
It is. And the number one criterion I have for the markets I trade is essentially liquidity. So they are the most liquid futures markets in the world.
Yeah. So, well, you actually just made a statement before about you think futures is the best instrument, and so is liquidity like the main reason, or do you think there are other pros to trading futures compared to other types of instruments?
I suppose the majority of people who trade come into trading because usually the first active trade is shares. And it's probably because although futures have been around for a very long time and probably longer than shares, most people are familiar with the idea of shares. They may have inherited some shares from their parents. A grandparent may have given them a portfolio to get them started. For whatever reasons, more people are more familiar with shares. Shares are great for trading, as long as they're liquid. But I suppose a big problem with shares is that what has happened in the last probably 10 years particularly is that because we've had so many, shocks to the financial system, that what's happening now is that the first default of a country's regulatory environment, say in Australia, is the Australian, ASIC, Australian Securities and Investment Commission. In the States, it's the SEC. Their first default position is they will ban short selling of shares, particularly shares of financial stocks like banks. So you may be an active share trader and things are going well. You buy and you sell short, and everything's good. But when the volatility picks up, when there's a shock to the system, that's actually good for us traders because we love things that move. But to have the local regulator, come in and say, well, sorry, you can only do one half of your trading, which is buy. You can obviously sell what you bought, but you can't go short. That limits a trader's opportunities. And with futures, we don't have that restriction. To my knowledge, I'm not aware of any futures exchange globally that, following a financial shock to the system, has imposed or prevented the exchanges from allowing traders to go short. So that's one of the biggest advantages of futures. Also, liquidity. In Australia, not many people are aware of this, but our local index market, like I would say for other nations around the world, each country's local index contract, whether it's a SPY in Australia, the Nikkei in Japan, the Hang Seng in Hong Kong, or the FTSE in the UK, is generally the largest equity instrument in their market. For example, in Australia, our local futures contract, 1 point is worth $25. Now, if a SPY futures contract is on 25,000 contracts today and around a value of, say, 5,600, that's the same as a value of $3.6 billion. And would you know that the largest individually traded share today on the Australian Stock Exchange is roughly, it varies, it can swing between $200 million to $100 million. And that's minuscule compared to our local index futures contract. So liquidity, nothing beats the index contract. And you also get 24-hour protection. Most stock exchanges are very active during the day, and they usually shut down overnight. And so for active share traders, you are exposed. You can always open a futures account to hedge positions, so you can still access futures to protect yourself. But you are only trading basically 1/3 of what's available within a 24-hour clock, which is during the business hours, and that's a restriction. While with futures, you find that most markets have a continuous market where there's like a day session and a night session. So for traders, it's all about managing your risk. Getting in is pretty easy. It's getting out when you want to get out. That's what's important. And futures does give you that peace of mind that the markets are open. They are not as liquid overnight as during the day, but you can get out. So another thing too is a bit of a dirty secret that the local stock exchanges won't mention to you. A lot of shares go off the board. Some are taken over, but a lot go into administration. They go broke. And exchanges don't talk about that. Futures exchanges, because there's the exchange in the middle, they guarantee the outcome of every contract. And so, in my opinion, I think futures are a superior, I think a wonderful instrument to actively trade.
Lots of good points there. Thanks, Brent. Now, I just wanted to move on a little bit to your trading approach. Now, how would you best describe what your trading approach is?
I'm essentially a price person, a pattern person. My primary focus is really price in a daily bar. And I'm not restricted to just one time frame. I look at multiple time frames. But essentially, the main tool I use is what you see on a daily bar. So the open is important to me, the low, the high, and the close. They're all important to me. They're important to me in terms of looking at short-term patterns, a sequence of bars. I might look for setups in my short-term stuff. I also, as I said before, we'll impose higher time frame price patterns over short-term price patterns. So on a weekly, a monthly, a quarterly, a yearly, price bar, each time frame has an opening price, and each opening price is important for that time frame, and it's important for the time frames below it. So I will have multiple layers of price. And my preference in dealing with price is that there is nothing perfect in the markets, nothing. And the best that I've found to give us, an honest piece of information of what's happening is the market itself, price. And that's why I do use a few traditional indicators, but not many at all. And the reason being is that I feel that indicators dilute the power of price, because indicators are just a derivative of the original, and I'd rather just focus on the original. Even though it's not perfect and it's got warts and everything, at least I know that when I'm looking at a daily bar, a weekly bar, a monthly bar, a quarterly bar, a yearly bar, and even a decade bar, nobody can argue about where it opened. Nobody can argue what the high for the period was, what the low for the period was. You're dealing with first instant information, and then I just look for patterns that occur regularly, and I apply trade plans to those patterns. And if there's a positive expectancy, then that encourages me to continue on with looking further into those patterns.
Right. So when you say patterns, are you talking about chart patterns like ascending triangles and cup and handle and whatever those things are called? Or
good question. I suppose when you begin your education in technical analysis, I suppose like 101 technical analysis, everyone gets introduced to traditional chart patterns like triangles and head and shoulder patterns and double bottoms and double tops and all the rest. No, I do not trade those types of patterns. Right. The patterns I trade, for example, where I start is I will start with, say, singular daily bars. And I will look for just an arrangement of bars that I think may have an ability to suggest a continuation of a trend or a reversal of a trend or simply a mean reversion movement. And I suppose an example of types of bars I would trade is everybody would know about, say, what a key reversal bar is. And that's just a daily bar where looking for a key reversal sell. If today opens below yesterday's close, makes a higher high, but then the market closes lower, it reverses and closes lower than the previous day's close, that's called a key reversal bar. So I don't trade that particular pattern, but that would be an example of types of patterns I would trade, is that just simple bar patterns. And my bar patterns will range from single bars out to 5 bars. And I just look at essentially what the shapes are and relative to your high to highs, low to lows, close to closes, the relationship between open to close. I suppose an example would be, everyone talks about candlesticks. Now, I personally don't trade any individual candlestick pattern, but I suppose candlesticks is a good example of what a pattern can be. And what I look for is just patterns that appear in markets that occur on a repetitive nature, that when you apply a sensible trade plan, it leads to a positive expectancy.
Yeah. So do you think these type of patterns have a tendency to be more robust over time, say, compared to indicator-based systems?
I just think they're more honest, because if you can find a price pattern that appears, regularly throughout your data set, that has a simple trade plan applied to it and gives you a positive expectancy, that pattern is more honest than a setup that involves a couple of indicators with a couple of variables. And why I say a price pattern is more honest is that a price pattern, if you're just looking at daily bars, a sequence of 1 or 2 bars, or a 3-bar pattern, or a 5-bar pattern, or a 4-bar pattern, those patterns either exist or they don't. There's nothing that I can, as a trader, do to create a setup out of thin air, because I can't influence a daily open or close, the high or the low. I can't influence the sequence of those patterns, right? So if I find them and they exist because that's what the market has done. Now, if I go across to a trading system where I've got a couple of indicators with a couple of variables, then unfortunately what I create is essentially a function of my fingerprints on the value of those variables. That I've created the equity curve, I've created the entries or the setups because I have so much influence on what value I place on that variable. And so I personally prefer to deal with price because it's honest and doesn't allow me to influence the outcome, if that makes sense. Whereas if I've got a strategy with a couple of indicators and a couple of variables, I become dangerous because I'm clever and I'm smart, and if I just change that variable a little bit, I'll miss that terrible loss that happened 2 years ago, and if I just tweak that variable over there, then I'll cut down that historical drawdown by maybe 200 days, and I become too creative. So I'd rather not be too creative with my strategies, and that's why I like focusing primarily on price rather than a collection of indicators.
Yeah. I guess with computing power these days, it can be very easy to data mine patterns like that. So how do you go about trying to determine if you've a pattern that you found is a genuine behavior in the market, or perhaps it's just a completely data mined curve fit random kind of pattern that may not work in the future? How do you go about trying to tackle that problem?
Great question, because am I lucky? Am I smart, or am I lucky?
Yes.
And it's amazing how lucky we all are when we're doing our research, and it's amazing how unlucky we are when we start trading live. Great question. The two twin evils, and there's plenty of evils out there in trading, but some very prominent evils that you and I would face as traders is the evil issue of curve fitting, and the other one of data mining. If we just happen to find a particular pattern that suits a particular market. And one way to reduce the risk of data mining is to run your ideas over a universal data set. Okay? And that's one of the first things I do. If I have an idea, I run it across, I've got a universal portfolio that I call my P24. And essentially, the markets cover the 8 main segments in futures. So you've got your currencies, your interest rates, your indices, your energies, your metals, your softs, your grains, your meats. And then within each of those segments, I take the 3 most liquid contracts. Okay, so I don't care what market it is, what the label is. I just look at my data and say, okay, show me the most liquid markets and sort it down to the least liquid markets. So my universal portfolio is 24 of the most diverse futures markets and also the most liquid. And so I select a portfolio which is objective or at arm's length to me. So I can have no influence over my portfolio apart from the criterion, 2 criterion, which is I want diversity, and then I want liquidity. So that provides me with a universal portfolio that sits over there in the corner. And so whenever I have an idea, I'll always run my idea over that arm's length, totally independent, totally liquid, diversified portfolio, and see if a pattern has a positive expectancy in that portfolio. And if it does, big tick, because you just haven't found a pattern that appears to work regularly in, the Taiwanese, or in, cocoa, or in coffee, or, in heating oil. So all of us traders, we need to avoid data mining, and a great way to lessen the risk of data mining is to get yourself a totally independent and universal portfolio to test your ideas on.
Yep. But I guess a little bit more about this universal data set. Some markets are, have different behaviors. So some are more mean reverting in nature and some are more trend following. So how do you balance that? I guess it depends the type of strategy that you're testing as to which markets it might be ideal for. And if you've got a broad range, how do you balance the results there? Like, what are you looking for?
That's a great question, because you're right. It's funny. You go from one extreme, one range of thoughts about the market. So a market is a market is a market. We shouldn't care what the y-axis says or the x-axis is time, but we shouldn't have to worry about what the y-axis says or what the label says, right? A market is a market is a market. However, individual markets do have individual characteristics, and the 2 general characteristics are some markets do trend some of the time, and a lot of markets go nowhere a lot of the time, and they're choppy. And so how do you manage that? What I do is I trade a portfolio of strategies that primarily fall within a trend following mode or a counter trend, mean reversion mode. And the idea is that a good trend following strategy should make good money when markets trend. When markets are not trending, and for the majority of the time, 70% of the time, markets are choppy, that during the choppy periods, a good trend trading strategy will take minimal losses. For mean reversion strategies, they should do very, very well when markets are just backfilling all the time. And when markets are breaking out in big trends, a good mean reversion system should minimize those losses during strong trending periods. Now, in my opinion, every individual strategy has to have be able to stand on its own 2 feet with an upward rising equity curve. Okay. Now the trick is, as a trader, you shouldn't become reliant on just one way to trade the market. And because you know that markets go through trending periods and non-trending periods, the idea is you should have a good trend following system and you should have a good counter trend following system, so that when you blend the strategies together, you'll get a smoother equity curve. But before you can do that, you have to ensure that each individual strategy that you trade, you be prepared to trade it on its lonesome, because it doesn't need another strategy to keep it on its feet. Does that make sense? Yeah. So everything's got to be independent, be robust, be free of data mining, be free of curve fitting, and have a nice upward sloping equity curve. It doesn't have to be smooth. I do not have a smooth individual equity curve. They're all rough, but it has to be upward sloping. But then when you blend them together into a portfolio of strategies, that's when the magic starts to happen.
Yeah. Well, it sounds to me like you're managing diversification at a number of different levels. Can you just give us a bit of an idea about your thoughts on diversification?
Sure. It's really, in my book, the Universal Principles of Successful Trading. I'd say probably about a third of the way into the book, I start talking to the readers about the importance of no longer considering yourself as a trader, but considering yourself as a risk manager. So when people press me about what I do, I essentially tell them I'm a risk manager. I just try and manage my risk because if you can manage your risks, it means you're going to be alive for tomorrow. You're going to be alive to place that next trade. And that's so important for us as traders. And in my experience, the greatest amount of effort and energy that's required to be successful on a sustainable basis is the risk management side of the business. Because guess what? Taking profits is so easy. They look after themselves. They cause you any anxiety, no distractions. Banking a profit's simple. It's managing the losses, taking the losses, being sensible on your money management, on your position sizing. That's what takes all your energy. So to help you manage your risk, diversification. You can have diversifications on multiple levels. One level, you can have diversification on markets. Don't be reliant on trading just one market. Try and have at least two markets. And as your account gets bigger, try and add more markets so you've got a diversified portfolio. On a strategy level, you need to be diversified between trend trading and mean reversion as two basic, sort of opposite type strategies. Now, not only do you have to have alternative or diverse trading strategies, but you also need to be diversified across time frames. So in time, once your account can afford it, you should be trying to have a trend following and counter trend strategy, not just across your normal time frame. That could be medium term, could be long term. Depends what people are doing individually. But once you feel that you're a complete trader, you should have across short term, medium term, long term, you should have trend following strategies and you should have counter trend following strategies. And that, in my opinion, is, I suppose, a minimum that you need to achieve to ensure good diversification.
Now, I just wanted, you made a statement before about your equity curve being bumpy. And so I just wanted to ask you, so you're the only trader that I personally know that publishes his real-time trading results on a website. And you've been doing that for a long time, for years, long before these trading platforms came along that would allow people to report their trade. So why do you do that?
Good question. I've been doing it since 2001, and the reason why I did it was because I didn't set out to enter this space of education and doing advisory. I was just like everyone else, a private trader. And back in the 90s, I was part of a very, very active trading room where there was only probably 5 or 6 of us that actually did post trades, and yet there was like 2,000 members in this trading room. And it was fantastic fun. And, I was 5 or 6 of us were posting, trades, basically live trades, and I was doing that and saying why I was doing it. It was fantastic. Anyway, one day, the ex-general manager of, at the time, Australia's largest trading educational firm in Australia, he joined our forum. And everyone obviously was familiar with this person because he used to be the general manager of what was then Australia's largest trading educational firm. And we thought, this would be interesting, see what happens here. And one day he posted a chart, and it was like, I forget what it was, but I'm sure it was a chart from 1940. It was a commodity. At the time that trading room, we were focusing on trading the SPY, the S&P 500. So it was like an index type room. And anyway, I got upset because I thought essentially what he was doing was he was just trying to gain interest for his new educational trading business. And so I said to him that, I disagree with what he was doing. Our room was for live trades, current trades, not for something that was like 60 years old, and not around a character that has a lot of excitement about, but very little substance. And I said that you're only here because you're trying to drum up business for your new venture. And I said that, what educators should be doing in Australia is, there's nothing wrong with selling or teaching people, but I believe teachers should be able to demonstrate they actually trade what they teach. and not only say that they trade what they teach, but actually show real-time results. And so I said to this guy that I was going to go off and get myself licensed and set up a website and make available a very simple mechanical model and make available the real-time results. And that's what I did, and that's what I've been doing since 2001. And it's purely just to say to the industry that, I'm no one special. If I can do it, why can't all these gurus do it? And so I'm putting it out there to say, to me, it's a minimum, requirement, I think, for an educator to provide their prospective customers or traders to say, you know what, this is what I do, how I do it, and also to bring an element of honesty into it, because you'll see at times I go through a rough time. And for me, for my medium-term currency strategies, they've been in drawdown now for a couple of years, and there's no sugarcoating it. And people have to see that trading is not all about profits. No, it's about handling and managing the losses. And so I did it because I just wanted to put some pressure on the industry to be more transparent. And I think while I do it, then other traders who want to learn from other people should say, well, if Brent Penfold does it, why aren't you doing it? So that's why I'm doing it.
Yeah, that's definitely an underlying theme with you, I think, is because, you publish your trading results and you're very honest with what happens. I remember you publishing an email a while back about the drawdowns, and it was really, really refreshing to see someone stand up and talk about it honestly. And I think it's really refreshing to have that in the industry because there are some sharks around, I guess. So, so that's cool. All right. Well, thanks, Brent. I might just start wrapping up now with a couple of quick closing questions. Mm-hmm. Biggest lesson you've learnt through trading?
Money management, risk of ruin, 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 risk of ruin. Being the best loser, be the best loser, be the best loser, be the best loser. Lose often, lose small, just get over it. It's just it's all about managing your risk.
I'll actually have to go back and see what you said for episode 2, because I think you said exactly the same thing. So let's hope we've said the same thing this time. All right, awesome. Now, what's the best way for listeners to learn more from you?
Probably jump onto my website, which is indextrader.com.au. Get a copy of my book, The Universal Principles of Successful Trading. And if people are interested in attending a workshop, I am holding my annual workshop in a week's time, would you believe, in Sydney on the 24th of June, where I'll be teaching my short-term index trading methodologies. I'm doing something for the first time I haven't done before. I am going to be doing a video conferencing of my workshop, which I haven't done before. And I've done that because I've had a lot of emails from international traders who are keen to be involved, but obviously they can't travel to Sydney. So if people are interested in learning some actual methods of how I focus on price and trade price patterns, they're more than welcome to attend my workshop. And if they go to my website, indextrader.com.au, and follow the links, they'll see references to the workshop, and there's plenty of information on my site about the workshop.
Okay, cool. I'll also have a link to the workshop and to your website on my show notes page, so people can find that easily if they want to find out more details. So thanks very much for that, Brent.
My pleasure, and good talking to you again.
Okay, awesome. I was just going to say, is there anything else that you want to mention before I wrap it up?
No. In my book, I say that the only real secret to successful trading is the best loser is a long-term winner.
Yep.
And if people can tattoo that on the back of their eyelids, then they're going to be taking a substantial step towards having a sustainable career in trading.
Yeah, a little bit extreme, but I think we get the point. So thanks a lot for that, Brent.
No worries.
Yeah, thanks for spending time with us today. It was interesting to talk about patterns with you. So thank you very much for that. And I wish you all the best, and I'll catch you in Sydney.
Great. Okay.
Cheers,
Thanks
mate.
for that. Okay, bye.
Thank you. Bye. Okay, well, that's it for this episode. Thanks for listening. I hope you enjoyed the show. Come on over to bettersystemtrader.com. That's where you'll find all the previous episodes, all the transcribes, all the show notes, and all the free weekly trading tips. bettersystemtrader.com.